So, you want to own a strip mall? Maybe you've pictured it already, a shining row of storefronts humming with coffee shops brewing endless lattes, nail salons buzzing with manicures, a pizza joint delivering late into the night. The ultimate dream, right? Steady, passive, income rolling in every month. Property that seems to almost manage itself, while you sip something stronger than coffee on a beach somewhere. Sounds like the golden ticket: be the boss, make bank, and never have to clock in again. But here's the real question: does it really work that way? Is strip mall ownership the effortless, cash printing machine it's cracked up to be in all those glossy Instagram posts and side hustle pamphlets? Spoiler alert, not exactly. Behind those shiny storefronts is a much messier, complicated story. There are wild costs nobody loudly advertises, tenant dramas that would make soap operas jealous, and financial surprises lurking behind every parking lot. Today, we're not just going to dip our toes, we're diving deep. We'll bust the biggest myths, reveal the numbers you don't hear about, and tell the real stories few insiders want you to know. You'll finish this knowing whether owning a strip mall is your next big break, or a square foot of headache waiting to happen. Let's get to it. Owning a strip mall is sold as the ultimate money hack. Passive income kings and queens preach it like gospel. Buy that commercial property, sit back, and collect rent checks while your bank account grows. The dream sells itself: be your own landlord, call the shots, and build wealth while others hustle 9 to 5. The online real estate influencers promise it's almost foolproof. Flawless tenants paying on time, rents that only go up, and appreciation that makes your investment grow like magic beans. Then there's the typical tenant mix: the local coffee shop that's always busy, the tattoo parlor with cool neon signs, or the quirky deli everybody swears by. You imagine a bustling little economy pumping out cash without you breaking a sweat. And let's not forget those eye-catching landlord flex posts on Instagram. Picture a guy in a sharp suit holding a rent check with a grin that says, "Look at me, I own a slice of the American dream." The emoji storm and comments praising his savvy only add to the allure. But here's the thing: those quick flip gurus and financial TikTok stars, they tend to sell you the highlights reel, skipping the bloopers. They'll gloss over months without tenants, rent checks that bounce, or the boss battles with problem renters. And yet the fear of missing out keeps people chasing this elusive cash machine because, unlike stocks or crypto, it feels real, tangible, and manageable. The carrot dangled is irresistible: steady cash flow, real assets, and the bragging rights of being your own landlord. So, the fantasy is seductive, loud, and persistent. But behind that perfect Instagram scroll lies a complex, often chaotic business that demands a sharp eye and a thick skin. Let's tear down that fantasy next and see what owning a strip mall really involves. But here's the twist most people miss: owning a strip mall is anything but cheap or truly passive. The flashy dream crashes hard when you see the upfront costs stacked against you. First, there's the buying price itself, which can easily run into the millions depending on location and size. And that's just step one. Before you even get the keys, you'll shell out for exhaustive due diligence, property inspections, title searches, environmental assessments, all to avoid buying a money pit. Then come the financing hurdles. Banks don't just hand over millions without paperwork thicker than a phone book. You'll need a solid credit history, a convincing business plan, and sometimes even a personal guarantee. Get ready for headaches negotiating interest rates and loan terms that can bite into your cash flow for years. Inspections can uncover surprising time bombs. Did you know that repairing or replacing an HVAC system can cost upwards of $40,000? Or that your parking lot, which everybody neglects, might need repaving soon, say, roughly $30,000? That old roof? It's not just a leak waiting to happen, it could hit your wallet for $50,000 or more just downhill from you. Then add in signage, landscaping, and security systems, all little fees that sneak up fast. Vacancy risk complicates things even more. Tenants moving out, lease breaks, or businesses going under mean empty spaces and no rent checks. Tenant turnover isn't just lost income, it's also lost time and money spent preparing the space for the next renter. Take Jake, a first-time strip mall owner, who quickly learned this the hard way. After a year, he faced a $120,000 repair bill, 2 storefront vacancies lasting months, and a messy eviction that ate up legal fees. His passive income became a passing nightmare until he got savvy. Owning a strip mall isn't a set-it-and-forget-it deal. It's capital intense and requires constant attention. But that's just the start. Next, we'll break down exactly how the money flows and where it can dry up. At first glance, owning a strip mall looks like a neat cash machine, multiple tenants paying monthly rent checks, steadily filling your pockets. But dig a little deeper, and the money flow is more like a mini economy that you're constantly trying to balance, slice by slice. Imagine a pie divided among a dozen tenants, each with different appetites, payment schedules, and moods, and you're the baker hoping nobody takes more than their fair share. Let's break down the main streams of revenue. The biggest chunk comes from rent, but not all leases work the same. There are triple net leases, where tenants pay their rent plus property taxes, insurance, and maintenance costs. This setup is a landlord's dream because it pushes most unpredictable expenses onto the tenants, trimming your risk and surprise bills. On the flip side, gross leases bundle those expenses into a flat rent. Sounds simple, right? Not quite. When something goes wrong, like a suddenly expensive roof repair or a spike in property taxes, you're footing that bill, and your profits take a hit. Then there's percentage rent, a popular add-on for certain retail tenants. Instead of paying a fixed rent, they pay a base amount plus a percentage of their sales once they cross a certain revenue threshold. This sounds sweet. Your income grows when the tenant's business booms, but it's also unpredictable. Sales drop? So does your rent. No one tells you this when the pitch is all passive income. Beyond rent, savvy mall owners squeeze extra dollars from things like advertising fees. Tenants pay for promoted spots on billboards, flyers, or digital signs within the mall. Small, but steady income might come from ATM fees or parking permits, especially in busier locations. Every little trick adds to the bottom line. But here's the myth busting: just because every space is rented doesn't mean you're swimming in profit. Unexpected vacancies, late payments, and rent disputes can chew up your cash flow faster than you think. Plus, you often need to invest in tenant improvements, those costly upgrades and renovations landlords agree to so tenants can open or expand their businesses. These investments often run into tens of thousands, sometimes hundreds of thousands of dollars, which must be recouped over time. To put it simply, you might need your strip mall to be at least 85% leased just to break even after mortgage, maintenance, and management costs. And even then, emergencies can wipe out that fragile margin in a hurry. So, strip mall ownership isn't the simple paycheck factory it's cracked up to be. It's a juggling act of managing multiple tenants, balancing lease agreements, and constantly adapting to financial surprises, all while hoping the pie stays big enough to share. Up next, the wild card that turns this balancing act from a numbers game into a real drama: the tenants themselves. They're the lifeblood of your strip mall, and sometimes, its greatest headache. Imagine renting space to a nail salon that seemed harmless enough until it turned into a lawsuit hotspot after an unfortunate allergic reaction made the news. Suddenly, you're not just a landlord, you're an unwilling party in legal drama you never signed up for. Or picture the beloved pizza joint that was the mall's crown jewel until the pandemic hit, and they stopped paying rent. One day, rent checks stopped arriving, and the eviction notices started piling up. This is tenant drama in a nutshell, and it happens more often than landlords like to admit. The relationship between landlord and tenant can swing wildly, from friendly handshake deals to acrimonious lease renegotiations where both sides walk on eggshells. You'll find yourself tangled in eviction fights that drag on for months, legal fees stacking up, and constant negotiations about who pays for what repairs. This isn't exactly what you signed up for when dreaming of set and forget income. Besides the cash stress, there's a massive emotional toll. Landlords often wear multiple hats: property manager, debt collector, negotiator, and sometimes even therapist. For rookie owners, the time drain can be shocking: phone calls at odd hours, emergency repairs, tenant complaints, and the sheer unpredictability of who's going to pay next month. But it's not all doom and gloom. Some tenants become long-term partners, and there's a certain twisted satisfaction in watching a struggling business turn around under your watch. And sometimes, landlord horror stories make for hilarious anecdote gold, like the time a tenant's overzealous karaoke nights ended with police visits and noise complaints, forcing an awkward conversation about business hours. Tenant drama shatters the myth of truly passive income. Behind every rent check is a story, sometimes messy, often unpredictable, and a landlord who's juggling far more than just numbers. Next up, we'll explore how seasoned pros manage this chaos and keep their strip mall profitable. Seasoned strip mall owners don't rely on luck, they run a tight ship using savvy strategies that most rookies never hear about. First, they diversify tenant mixes carefully, balancing stable, long-term businesses like grocery or dry cleaners with trendier, higher turnover shops. This spreads risk so one vacancy or tenant drama doesn't sink their entire income. Proactive maintenance is another secret weapon. Instead of waiting for things to break, and trust me, they will, successful owners schedule regular inspections and repairs to avoid costly surprises like that $50,000 roof replacement. This keeps tenants happier and saves money over time. Lease agreements get special attention too. Pros use precise wording, shifting as many property costs as possible onto tenants through common area maintenance (CM) charges. Think landscaping, parking lot upkeep, and even security. Rent escalations built into leases protect income against inflation by guaranteeing small annual increases. Most pros hand over daily hassles to property management firms, especially as their portfolios grow. These firms handle everything from rent collection to tenant disputes, freeing landlords to focus on bigger picture decisions. Behind it all is a mindset. Owning strip malls isn't some get-rich-quick scheme. It demands patience, risk tolerance, and a long-term view, favoring steady cash flow and equity build-up over flashy flips. It's not magic, it's smart management, attention to detail, and knowing when to get your hands dirty or step back. Master this, and you transform a potentially chaotic investment into a resilient, profitable business. Next, we'll see what the payoff looks like when these pieces come together. So, what does success actually look like when all the dust settles? Let's paint two pictures, best case and worst case. Imagine you buy a $3 million strip mall. In the ideal scenario, you stabilize occupancy around 90%, tenants pay steadily, and your triple net leases keep surprise expenses at bay. You start seeing positive monthly cash flow by year 2, and over 5 to 7 years, your mortgage balance shrinks while your property value appreciates, building real equity. When you decide to exit, you might sell for a solid profit, refinance to pull out equity for new investments, or use a 1031 exchange to defer taxes while upgrading your portfolio. Now, the worst case? Vacancy spikes. A few big tenants drop out, and unexpected repairs gobble your reserves. Cash flow dries up, forcing you to cover bills personally. Property value stalls or drops due to location shifts or economic downturns. The rise of e-commerce and changing consumer habits can erode foot traffic, putting additional pressure on rents and occupancy. Market location is king here. Strip malls and growing suburban areas with strong local economies tend to outperform those stuck in declining retail zones. Economic cycles also hit retail hard, meaning timing matters more than you think in a business that's often leveraged with debt. So, if you bought a $3 million strip mall today, expect your first 2 years to be a groundbreaking even or even operating at a loss. But if you survive, the slow build can create steady income, equity growth, and long-term wealth. It's a marathon, not a sprint. The payoff exists, but it's earned through persistence, savvy management, and a little patience. Owning a strip mall, the idea sparkles with promise, steady income, real assets, and the allure of being your own landlord. But as we've seen, the reality is layered with unexpected costs, tenant dramas, and management challenges that turn the passive income myth on its head. It can be a gold mine if you approach it with sharp management, patience, and savvy strategy, or a money pit if you dive in blind and treat it like an easy payday. So, is owning a strip mall your next big move? That depends on your appetite for risk, dedication to detail, and willingness to embrace the messy, unpredictable business behind those charming storefronts. Now I want to hear from you. What's your wildest landlord horror story, or dream investment you're chasing? Drop it in the comments below. And if you enjoyed pulling back the curtain on strip mall economics, hit subscribe and ring the bell. We've got plenty more surprising business ventures to unpack together. Until next time, keep dreaming smart and investing wiser.